Hello, this is Andrew Pancholi, and I want to go into a bit of information on how to use the market timing report to its best capabilities. But before we do that, in the following video, I'll just give you a bit of background to why we created the market timing report and what its purpose is, the big picture on it. So I've been researching cycles with my team here for a long time, over 30 years in fact, and we've worked with a lot of very interesting people. Our research has covered pretty much every angle relating to cycles that I've possibly been able to unearth. I've studied a lot of Gann information, I've studied Hurst and a whole series of other things, and as you know, I'm also on the board of the Foundation for the Study of Cycles. We're big into researching this, not just for markets, but for recurrent events, geopolitical cycles, and so on. Our journey's really left no stone unturned. And what's happened is that over the years, I wanted to try and get the best of the best out of these different areas that I'd researched. And so we created our own software system, which is the basis of the market timing report, the histograms that you see, which is the most important thing. But before the market timing report came out, which was only a few years ago, we were using this information, and we still do, providing hedge funds and major players with this information on timing. And that's what it was all about. Word got out that we were able to accurately time, for the most part, I know we're not perfect, but for the most part, get some good timing handles on various markets, and across a whole series of markets, as well as geopolitical prediction, because these mathematical cycles are the same, as I said, in markets, in geopolitics, in your lives, believe it or not, and they just work over different time frames. So that was the whole point, was we created these cycles, we put all the secret sauce in and created these histograms, and these histograms work at different levels. And basically we were advising a handful of major players very happily, as well as happily successfully trading. And as I say, word got out, and people asked for this information, so we created the market timing report. Now, as of January 2020, we are including 6 items in this. There's the S&P 500, gold, crude oil, the euro, the dollar index, and now Bitcoin through the GBTC. So we'll provide turning point information on that. So that's just a quick overview. What I'm now going to do is go into each subsection, but the key point really is that you do need your own systems to make this work. It's not a standalone system. Having said that, I'm going to come back to that in a minute. And we found that the people using this the most successfully already had a plan, and they just use this for confirmation and so on. And in fact, let me take this opportunity now to go a bit further. So the idea really is that where the more the longer term cycles, so the weekly cycles that we put in red, and I'll again address those in the forthcoming video, come in, those are tied into where we might see a trend change. The daily cycles just give us daily trend changes. But in the perfect world, if you have a weekly cycle and it overlays with a daily cycle, then that's a point where you're likely to get a substantial trend change. So in the old days, or not in the old days, even in the present day, trend followers would just keep going, and they'd raise their stops below the previous swing or 2 swings back. And of course, when the trend changed, the first they'd know about it is exactly that when the stops were taken out, by which time they'd given a much larger part of their profits back. So the purpose here is that this enables you to effectively vary your hedging or tighten your stops up as you approach your timing window, assuming you're in that trend. And we don't recommend that you take a reverse position straight away. You need proof that a market's turned. And once the market's turned, then the timing point has helped you, because we know that there's a timing cycle in suggesting a turn. The market's proven it, and now you look for the opportunity to get in there. So that's basically how to use this information as an overview. I'm going to do the deep dive in a minute in the next video. But I want you to know that. But also I want you to know that several of you are newer to trading, and you don't necessarily have a system. So you will very shortly have available, in fact, by the time you watch this video, it'll probably be available, a course available from us that I'm creating that really is the best of everything that I've learned about trading in the last 30 years, the techniques that really work. They're surprisingly simple, a lot of these, and they're very, very successful. So I'm going to put those in there. We're going to make that available to those of you who want it. We know it'll be useful to those of you that want some guidance, and it's a full system. It's only available through the market timing report. There are other companies that I have been involved with that continue to sell my work. That's not the most recent. It won't be updated. So I just want you to be aware of that. So let's go forward into the next video and take a deep dive into how to use the market timing report to its most effective level. Thank you again. So let's take a look at the benefits and how to use the market timing report. First of all, the report is published monthly and it comes out by the first trading day of the month. So if the first trading day of the month isn't till the 3rd, sometimes you might not get it till the morning of the 3rd. And the reason being is we like to use the most up-to-date data and write the report from there. You can access it either from the email we send you, or you can go to the members area, or you can do both. Also, within the members area, there are several other reports and other information, and this video will be in there as well. So the market timing report covers the S&P 500, gold, crude oil, the dollar index, the euro against the dollar, and we've recently added Bitcoin to it. So these are the 6 main markets. Occasionally we'll add extra reports where we see other opportunities arising. Now, several of you who subscribe already work for major institutions, banks, hedge funds, etc. So you know how to use this information. And basically it's there to just add an extra input that will hopefully give you the edge about when a market's about to turn or something may or may not be about to happen. A lot of you also are private traders, investors, and for you the benefits are really, it gives you the advantage in trading your own 401ks, your retirement funds. So, you know, if you're in the UK, if you're in Australia, your superannuation, your supers, etc. And it's about looking after yourself and knowing what's going on. It's not about making your broker rich. I've said it before. You know, brokers get very rich churning accounts, and fortunately that's not how we want to do it. We want to make you rich. So it's all about personal empowerment. And this is an extra tool. It's not the Holy Grail, but it's an extra toolbox that helps add to your decision-making process. As I've said before, it's something to supplement an existing trading and investing system if you already have one. And if you don't have one, we're going to be providing one, making one available to those of you who haven't got one very shortly. So that's the background to the market timing report. Since it's been going, I think we started it in 2014. These are the various moves we've called. We've caught pretty much every major swing on the markets, on the S&P there, and other markets that we covered. I think we've already spoken about that. But let's go into a bit more detail. So on the front page, I put up the key dates. And these I believe to be the most significant turning points. They usually relate to the S&P 500, and in this case, let me show you how it works. So this here, we've picked these 2 dates, the 4th and 5th of September and the 20th. Well, there's the 4th and 5th. So yeah, it's a tricky one to call. The market's been going sideways, but that's where it breaks out. So these are areas where you look out for potential moves. And if you are a more experienced chart reader, in this case, you'd see that we were clustering in a range, and then we came back, and then we popped up. And so we only came back halfway there. And that in itself is quite telling. So we'd be using that, and we did use this there to look for a potential move up. These are daily cycles for the most part. Sometimes they're packed up with weekly cycles. More on that very shortly. So you can see there the market then popped up, and this was our next cycle date. And basically the market move actually expired probably there, but you can see this is where the next move down started. So but the idea was that if you were long, you'd really want to be protecting your position by this next main date. There are of course other dates. These are the main points but this is just giving you an example of why we use the cover dates per se. So once we move into the report, the last few years we've been using the report to provide geopolitical commentary, which has caught a lot of people's attention. We use the same mathematical cycles that are prevalent in markets. They are also prevalent in geopolitics. As I say, they're also prevalent in life cycles. And this basically gives us, it's like an early warning radar or night vision goggles, we get an idea of where trouble might be about to flare, and therefore we can capitalize on it. As traders, it means we can look to see where we might see opportunities before they actually hit the news. And I think we've been very successful. We did call for a geopolitical crisis the very first week of July. We called for China to melt down last year. We've seen that in the form of Hong Kong, and we're seeing conflict in India and Pakistan, as has been predicted. The whole Iran thing, we wrote a major report on Iran, and that's playing out, and we believe the Middle East is really going into some major cycles right now. And I've talked about them elsewhere. But, actually, let's just talk about them now. Basically, we're seeing right now a repetition of the 45-year cycle from the Middle Eastern oil crisis. We're seeing a 30-year repetition later this year from Saddam marching into Kuwait, which led to the first Gulf War. A 10-year cycle coming in from the Arab Spring. So those are just a few of them. And I also mentioned there's a 72-year cycle from Israel being founded, which, there was some trouble as that was brought into place as well. So all these cycles are coming together, and that suggests the area will destabilize. So that means that you might want to be looking at gold or oil. Oil would certainly be a commodity, but it's not as simple as that. You'd have to apply your own analysis and your own trading system to it. But that is the point of providing the geopolitical commentary. So next up, after the geopolitical commentary, I talk usually about the US markets. I go into some analysis on that and what my views are on that. And then we have the how did we do section. So this report's not perfect. The daily cycles work within a day either side. We tend to put some up here that work and some that don't work. And we believe for the most part we have something that gives people the edge, as I will be the first to tell you it's not perfect. But we do show this, and again we put key dates up, etc., and point these out to people. Now, this is the really important stuff. It's a little bit heavy, it's a little bit dry, needs a bit of a nice sauce on it. But for those of you that really know how to use it, you benefit substantially. I've had some fantastic calls, and some of the success stories I've heard are just phenomenal. So let's go into the data section, and we'll give you an overview. First of all, we have a red section at the top. This red section is the longer term cycles. So if you're an investor, these are the cycles you want to look at. These are the main swings. Then we look at decennial patterns, and I'll come to that in a minute. You'll see why. And we look to see if there's any correlations there. And then we use our profit finding Oracle system, and we provide you the dates. Then we look ahead a month as well. And then we look at one-day probabilities, and then we give you a little bit of a strategy or conclusion or overview thing there. Let's go into a bit more detail on those. So the idea here is the red information for investors, and these are just taken out of the report. So this is not relevant. In fact, these are taken from an older report deliberately to stop you getting confused. And it depends when you're watching this as well. So it's all this is an educational video on these cycles. These cycles there. So the idea here is that we look at weekly and even monthly cycles, and where these come in, we get significant trend changes usually. These are the important ones for trend traders. They're not for more the short-term traders, as it were. These are where, well, they are for short-term traders, because this is where the big moves are going to expire. So this is quite important information. We put that at the top. So if you want to put it in a simple way, what's the most important piece of information on the page? Usually the red writing is the most important writing on the page. And when we follow that up, we then look at the decennial cycles. And the reason we do decennial cycles is we look for patterns. And in this case, and this actually is out of the very latest report, because it's a really good example. It doesn't always happen like this. I'm holding my hand up here. Yes, we are doing our best to serve you. We don't have the Holy Grail, but we certainly have an advantage. So what we're seeing here is that the 10-year cycle and the 20-year cycle both made turns on the 6th and 7th of January, very close together. One made a high, one made a low. But the point is there's an inflection there, right? And then actually we saw one on the 3rd in the 30-year cycle. So basically we're saying the 6th to 7th was quite an interesting turning point there in this market. And let's we'll come back to that in a minute as well. But here we go. The reason we look at decennial patterns in more detail is because you can see here, looking at the 10, 20, 30-year cycles in crude oil for the year 2020, you can see they generally, the blue line is the average of them. You can see they generally trend together in this part here. So this suggests round about this area they're all turning, making highs. And you'll see this sort of area here. Two of them are collapsing, one of them's going up, and again a little bit of a trend confirmation there and so on. So it's not perfect, but it's all about getting the odds on our side. So coming back to this 10-year decennial pattern we saw, in this case we had highlighted the 6th to 7th of January as a window because it came up in two of the cycles, and we had one a few days before that. But when we looked at our profit finding oracle system cycles, which is what we have, which we'll show you in a minute from the histograms, these are the proprietary part of the market timing report, we found there was a date there for the 6th to 7th of January. So this is interesting. We're seeing this here and we're seeing this here. This is giving us more confirmation that this is going to be quite a strong inflection point. And an inflection point is basically a point where we might see a turn or something like that. And this is what happened at the time of filming this. This is exactly what happened. There was the 7th, the 8th was sort of spike up. This was the Iran missile attack that took place. And that's how it works. And the reason this was such a strong point was, as you'll see in a minute, there were also weekly cycles coming in here as daily cycles as well as the decennials. So this is like a perfect overlay. It doesn't always get as good as this, but when it does, it's a strong one. So that's always quite good. So now I want to move into the next section where we show these profit finding oracle systems, but giving you an overview that these relate to daily cycles. The daily cycles tend to fall at the top where we have triple overlays. We don't often show these because they can be confusing. They can be misinterpreted. But the idea is that where we get a weekly cycle or a monthly cycle tying up with weekly and daily cycles all in close proximity, we're likely to see, in the perfect world, they'd all be aligned like these two, and that gives us that low there. But here you can see there's this but a slight alignment, and we've got a double situation there, and here we've got a major turn there and so on. So this is just another example of how we use this information. Here is an even better example where we got a monthly cycle. The weekly cycle was slightly away from that, and the daily cycle came in there, but the daily cycle allowed us to fine-tune this to the exact day, and that's just again a really good example of how this works when they do all align. But each of these, as you can see, by the time we've got a spike here, we've got a turn here, etc., and we've got a bigger situation developing just off the back of there, and so on. So this is how the system works. So I'll go into a bit more detail shortly on that. So what we also see is that not only do we put in the current profit finding oracle system dates, I put them in for the following month as well. Now these tend to be a bit coarse because the cycles are a bit further out. So that they're for people who, just in case we get the report out a bit late or anything, or we're quite close to that, we like to get them out there and we'll fine tune them. And sometimes they change and sometimes they actually intensify. So that's the profit finding oracle system explained in the report. Now what I want to do is just take you into our software and show you exactly, show you in a lot more detail how they work. Now let's move on to our proprietary profit-finding oracle histogram dates. These are really what the report's all about. This is the unique thing that we provide at Cycles Analysis and the Market Timing Report. And here is the S&P 500 index going all the way back to 1964 with the very long-term cycles, the monthly cycles really showing here. And just open that up so you can see that. Basically, what we can see is, look, there's a very big, let's have a look over here. See, there's a recent spike there. And if we line that up, you'll see that coincides exactly with that point there. The highest spike there gave us this point here exactly to the month. We got a low coming in there on that high spike. There's the 87 crash high exactly. So you can see how this works. But this is sort of, it's not retrospective. It projects into the future, and this is what we're trying to serve you with. These show potential turning points. They're shown all the way here through to, looks like July 2024. You can see there's going to be some interesting stuff happening at this time here, and also round about here. So these are the cycles we keep you posted about. And these are the super long-term cycles. So this is a monthly chart of the S&P 500, and we then look at the weekly and the dailies to see if we can fine-tune the moves. In fact, Let's go and have a look at a gold chart now, and let's go over to. So here's a gold chart that's a weekly gold chart, and same thing now. If you've been with us a while, you'll know we absolutely called this point here. We call this point here as well, and you can see why, because we've got these spikes here. So we knew something big was happening. Now, a word of caution about these histograms. We know what's in them and we know how to interpret them. So when we get a cluster, sometimes they're as strong as when we get a spike. What we've done is we used to publish a lot more of them, and we can put them if you want them, but they do need interpretation because there's a bit of a recipe. There's different sorts of formulae that are going into them. So an absolute outright spike is always strong like this, and that's why you got the high exactly there, and we call that for you exactly. But here we've got a cluster of several cycles, and that's why we got this fuzzing, but an important turn there. And go back, look at this here, we were slightly out. So it's not a perfect system, but you can see for the most part these big cycle clusters call pretty important turns. And there we go, there's another one there, and that's why we need the smaller cycles as well in between. So you can see this here. You can see that this here is the very first week of January. We had this in our report, and I want to show you now how we put this all together. See, there's a big spike. That was the Iran situation going on there. And before I leave this chart then and show you how we put this together, just bear this in mind. The first to second week, the week ending 10th of January, big spike there, and a big cluster there. But also, we've got stuff coming up here, and you can see 24th of July 2020 will be a very important week. So just thinking there, thinking there about the this first week of January. Let's move to a daily chart. So you've seen that the big picture, like we showed you with the S&P. We do the same with gold. Look at a monthly chart, we look at a weekly chart, and look what was happening here. So on the 7th, 8th, we got an absolute peak. And what happened? Take a look. There it is. There was the high. And so can you see how this overlays back with this weekly chart, with this weekly cycle that we have here, and the daily cycle? So this is really what the histograms are all about. And again, as I say, they project into the future, in different time frames. And we use a whole series of them just to cross check as well. So as I say, that's our proprietary formula, and we keep that there. And right now we're looking here. Sorry, this is our weekly chart. We've looked at that one, but just come back to the daily chart. You can see that probably expect something happening around about the 11th of March. But the shorter cycles need more fine tuning, and they can be out to within a day or two as well, as regular readers know. But they give you a clue. But the important thing is where they're aligned with weekly cycles, and better still monthly cycles as well. That's why they all come together. So that's the profit finding oracle histograms. You now understand how the profit-finding histograms work, and these are the most valuable part of our market timing report. Next up, we put these high probability directional moves. These are one-day moves based on seasonality. After that, we pop in our overview, conclusion, potential strategy. Now, this is what we feel at the beginning of the month when we release the report. Obviously, as the month goes on, things change. But these are my views usually around about the beginning of each month. So that helps with that. And then as we go over the page, we move into the seasonal probabilities, seasonality, and these give us setups where the market's going to go on an annual basis. And here's a further video about that right now. Let's take a look at the seasonality module. So what seasonality is the average path of the market in any one year. Here we have the S&P 500, and what we see is, you've probably heard the adage, sell in May and go away. Well, it tends to make a high round about then, and you'll have almost certainly heard then of the Santa Claus rally, which is the year-end rally. And so this is actually data going back well over 60 years. Typically in the report we'll just use the last 30 years because it's more accurate. But just to show you exactly the principle here is that in a normal year, this is the average path of the market. It's called seasonality, basically. Now, of course, the first thing to notice is actually in the case of the S&P, it just heads up because the stock market's just been going up and up and up since well, since it began, really. I mean, yes, we do get pullbacks, but on a seasonal basis, this is average seasonality. Now, we do several things here. First of all, you'll notice that we have high probability days of moves. So if we just look at the cursor here, on this day, which is the 25th of October, you'll see that in our samples, we've got a total of 21 up samples and 29 down samples in this long data set. As I say, it goes, I think, back to 1951 that we're looking at here. Remember also, some of these years, these days will fall on weekends, so we lose effectively 2/7, 2 days out of 7 there. But here you can see 21 of these go up and 58 down, so that shows 42% up, 58 down. No great probability. But when you start getting towards certain points, see, there's a 50-50 day on the 27th of October. But then we see something really interesting. On the 28th of October, this is the beginning of the Santa Claus rally, and we'll look at that as well in a minute. But let's take a look at the 28th of October. 34 samples up, 14 down. 70.8% probability since 1951 that the market will make an up move on that day. Is that information that's useful to you? Yes, it is. And how do we use it? Well, I'll come back to that in a minute, but just let's have a look at the next day. Next day we dropped 52% up, 48 down. So what we can see is that there are some days where the market's very strong. And then here's another one here, again, at the beginning of November. 3rd of November, 70% up day, 29.5% down day. So what does this mean, and how do we use this? Well, if the market is already trending up and you've got an up day the next day, then the chances are the market will keep moving on up if it's a high probability up day. And that's why we pop them into the report. And I'll show you that picture in a minute. In fact, here it is. Here are the probabilities, the daily probabilities. So the point here is, as I said, if the market's heading up on the 5th and the 6th is a trading day, that's a high probability up day. The market should carry on up. But if the market's heading down, then you're going to be up against some resistance. So this isn't the holy grail in itself, but it gives you some probability odds. And so that's really how you use it. I mean, there's a case of the S&P. And again, looking at oil, here we go. The 12th of November typically is a 90.5% down day since 1989, so in the last 30 years. So again, you can see that if the market's trending down, it should carry on down through that day. If you're approaching support or resistance levels, then you want to be careful. And say the market's heading down into a resistance day, then into a resistance level, then it's probably going to continue down towards it. But if there's a big up day, you might start seeing a reversal as it hits the downside, and the opposite is true for an up move. So, if you've got a very big up probability like we had over here, and the market's approaching say the market's coming down, but you've got a high up probability move and you're at a resistance level, then that's going to help your odds of the market reversing, if that makes sense. So it's a very coarse indicator, but that's what these notes are here. Returning to our seasonality situation, when we look at this, again, the S&P, what we find here is these are the seasonality profiles we pop into the report. In fact, let me show you that first. And here is an example. We prop these in here. In this case, from this particular report, it shows that the S&P is closed higher on the 4th of December. That was trading on the 23rd of November on 70% of occasions. And that was using the data up till the publication of that report. But looking at it in the bigger picture, let's say, well, this is obviously an up move. So if we started going long round about here on the 27th of October, you can see that actually, look at that. If we go to year end, in fact, specifically the 29th of December, there's a 78.3% probability in our data set, which in this case goes all the way back to 1951, that the market will close higher. Now, this is now getting the odds on your side. And then just here, we print this down. This is from our system where we just see how many up moves and down moves there have been through the years. Equally, we might see something like, well, look, there's the high there in May, and let's see if we were to sell it there and come out here. Interestingly enough, it's only 52.47. It's not a very high probability setup between the 4th of May and the 24th of May, despite the adage, sell in May and go away. So let's have a look. This is another setup here. Again, this is a high probability setup. 26th of June to 14th July since 1951. It's nearly 74% chance of it closing higher. So these are the seasonal probabilities we put in. Certain commodities like oil have very clear tendencies. So oil tends to make a high around about the beginning of October and comes down to, say, here. Let's have a look. You see, if you look at the numbers at the top there, basically looking at the 16th of October, comparing it to the 11th of December, here, between those dates, there's a 61% probability that oil will close lower, and this is in the last 30 years. If I move this back up here, take a look at this. The date from the 16th of October to the 27th of November actually gives us a 72.7% probability. So that's a stronger probability. Now, how do we use this information? Well, quite simply, this is where the seasonal profiles live. And if we've got profit finding oracle dates, the histograms that tie up with this same area, then that makes it a very, very useful point. That's going to give us confirmation that seasonality is probably going to work, especially if the market's going up. We know which way the market's going as we see it. If it goes up into that point, that's exactly where it is likely to turn. If there's a PFO date there, and better still, if there's a daily date there and a weekly cycle, we know it's almost certainly going to turn. Obviously, we're not just going to jump in. We're going to wait for the market to prove itself and be able to manage risk and reward. But that in itself could be a great opportunity down there. If there's another PFO date here, that's great. But here's the trick, right? If there are no PFO dates or weekly cycles or anything clear, if it's, say, all the way over here, then this trend will likely continue down towards here. All right, will likely, not definitely, because the PFO dates are the individual DNA of the market, so they're very specific to the market at that particular time. Equally, if the PFO dates are here, then that trend's going to stop short. And if there's some major PFO dates here, it means it's going to be a very short-lasting trend. So that's how we use this information on seasonality. And whilst I've got it here, here's some seasonality on gold. You can see that gold typically makes a significant low. Well, actually, it makes a low here at the beginning of August. And if we watch this, have a look, there's typically around about, between the 6th of August and the end of September, there's a 66% probability of gold closing higher on those dates than it was trading there. But equally, we could just zoom in and say, well, that looks a bit more exciting. And that's exactly what we put in the report, the more specific, closer in ones. And here, on average, 13th of September to the 25th of September, 72.1% chance of the market moving higher. There are, and we've got 31 samples up, 12 samples down. So that's how we use that. And again, we use the profit finding oracle dates to provide confirmation. If we don't have anything around here and the market's heading down, or it could be heading up, then we're not going to get a reversal. We're not going to get a change. We're highly unlikely to. The daily cycles can help us with this, and the weekly cycles give us the clues for the bigger moves. So, if we've got a big cycle down here, this typically would be the average low in a year for gold. So that's how that works there. So how do we use this? Well, there's several ways that we've shown you already. Using Fibonacci levels is a common trading technique. And what we found is that if you do have a time cycle coming in at the same time as we're approaching a particular Fibonacci level, then you're likely to get the reversal. However, so say if a market's made a high and it's coming down to the 382 level, if there's no time cycle at that point, it's unlikely to hold. It's going to carry on through to the next one, which is more than likely going to be the 50% level, the 0.5 level. So that is, again, another benefit of using the level. And it's the same with, if you might have other support and resistance levels for an experienced trader, and that's exactly how we would use this information. So that's that. And here's an example. We showed you some histograms on gold. This is something we published, and I just want to run through this with you. So here we had a significant turning point for the last week. We had a weekly and a daily cycle. I think, in fact, here we go. There's the daily cycle, and then what do we see? We see a major series of weekly cycles in the last 2 weeks of May. So this is taken from close to the time. The gold has been a lot higher, and it's starting to come down. But basically what happened here was, as a trader, right, or an investor, you know that gold is in a downtrend, and you know you've got this big cycle here. So what's going to happen when we get to this point? Well, what we're looking for any trend change confirmation is basically a break of this trend line to start with, which we got there. But did we get a confirmation? No, we got a triple bottom coming in. So we were making lower highs, lower lows, and suddenly we're not. And then we got a breakout through here, and we broke out above here. And we knew then, because we had this time cycle, that we were potentially looking at a trend change, and that's exactly what happened. So this is how you use this information. And we used a series of other techniques like pitchforks and so on. And just this first initial move, was quite a substantial move. So that is how you use that, and that was something we put out to many of you. In fact, it was in the reports as well as people are on our list. So that's how you use that. We also use pitchforks. So basically here, I'm not going to go into those. We cover them in our trading course if you want to know more about those. But basically, on the course on how to use a market timing report. But basically, you get up here and we're hitting this level, but we're not. There's no time cycle, and then we get the time cycle, and off it goes straight down to the next point, which is likely to hold, could hold, may not hold. There are rules around that. As I say, we cover those in our course, and there is a time cycle there. So boom, that suggested a reversal, and off it went. And there was the next reversal. It fell slightly shy, but there was a start, a strong turning point date there, and it fell slightly short, but that triggered the next move down. So this is how it helps. It gives you confirmation of potential moves or potential action. So the beauty really of the market timing report, it's about knowing when things are going to happen. Trading and investing can be hugely enhanced by timing. I'll be the first to tell you that this is not a perfect report, but it certainly gives you a distinct advantage. I know, as I say, I've consulted to funds, multi-billion-dollar funds that use this sort of information and really use it very effectively. I've also spoken to our subscribers who use it very effectively, people with family offices, etc., all around the world. So it is there as a tool to enhance what you're doing. It is not the holy grail. As I say, for those of you that don't know how to use it, that we do have a course which then gives you strict rules on risk management and how to enter and exit positions and so on. Then the last page of the report, right, it has a summary, and we brought in Bitcoin, and these gives us clear dates of when things are going to happen. And this is just, I've just taken this out of the latest report because we've added Bitcoin to it. But what I want to show you is from a previous example. If you look at this grid and you see clustering there, that means there's something happening across all the markets, especially on this date. When you see that, that means it's likely to be a more global, important financial story coming out. It's likely to be a more significant day. So, again, that's what it's all about. And just remember, I do get people trying the reports, and the office sort of gets a few emails from time to time saying, I don't know what to do with it. Well, basically, these are potential turning points. We do know the direction of markets as they head into these turning points. 90 to 95% of the time, they're reversals. When you get multiple confirmations, so if you get a monthly, weekly, and daily cycle all coming together in a very close window, you're going to get a big change of trend. Where you get the decennial cycles backing that up, that's going to help. And even the daily single probabilities are very useful. If all that information is also tying up with the direction, the seasonal direction of a market, you've got a full house, and that then really gets the odds on your side. It does mean you have to do a bit of work, but that's what we're here for, to try and get the odds on your side. So that's an overview of the report. As I say, it works with fundamentals. So fundamentals phenomenal. Obviously, a lot of you are fundamental traders, and basically, something's about to happen, but you don't know when. But the flip side to this is the market timing report can quite often identify dates where they're going to be what others, or fundamental traders, would call black swan events that could not be predicted. And again, the geopolitical events of early January, we've been telling you about that from the last two reports. We told you the first 2 weeks of January were critical. We mentioned it in December. We told you again in the January edition, which came out before the events occurred. And we've been able to see these things unfold. We've seen China unfolding, etc. So it's there to give you a little bit of a backup. It's very good for protecting trending positions. So the idea is that if you are long in a commodity and we have some big cycles coming up in, say, crude oil or whatever, or gold or the dollar index, you're long, and we published some major turning points, then you know that there's a potential then for the trend to run out of steam, and you want to be protecting your trend at that point. So either start closing parts of your positions off, or increase your hedging, or just take profits, whatever. And that's very, very useful. Fibonacci levels, I've already spoken to you about that. If you get to a Fibonacci level in whatever time scale and there's no major time cycle, then basically not much is going to happen. However, if you get to a Fibonacci level and you do have a time cycle, you are likely to see that Fibonacci level hold and a possible reversal take place. Andrew's pitchforks are phenomenal. All these things, again, are covered in our course. You either use them or you don't at the moment. And commitment of traders data. So one of the challenges that came up was that people say, well, what's the direction going to be? Now, we've started working, we've always been looking at commitment of traders data, and we're going to be offering you shortly a package that gives you this data. And the point behind this is that the commitment of traders data will give you the potential direction. But the data only comes out once a week, and it can create a window of a month or 6 weeks even, and a change is going to happen, but you don't know when. But if you do know, for example, and gold's been a classic situation here on the various moves, as you can see the extremes there of how the professional traders are positioned, the hedgers, and so on, the commercials as we call them, and you know what they're doing, and you know why they're doing it. And if that ties up, when they get to extremes, there's going to be a big reversal. And when you know they're doing that, and you have a timing point, which is what we provide you with, you really have a fantastic setup that you can potentially enter with very low risk and potentially high reward. There are numerous other techniques that several of you use, and so on. So there it is. It's all there for you. It provides timing information to enhance your existing systems. If you don't have a system, we will be offering you one shortly. Thank you so much. I really hope this helps, because after all these years, the feedback has been help us out a little more to understand how to use the report. I hope this has helped. If you want more information, send us an email, support@cyclesanalysis.com. Tell us what you want to know. And really, just remember, this is all about getting the odds on your side. There is no holy grail. Thank you so much.